Let's turn now to the issue of savings. And peer-to-peer lending is gaining more prominence in Australia as bank customers increasingly choose to withdraw money from their savings accounts in favour of it. In some cases, people are earning 3 times the interest on their savings. But peer-to-peer lending is not without its risks. The Principal of Digital Finance Analytics, Martin Norse, joins us now. Good afternoon, Martin.
Hello.
Can you start by explaining to us exactly what peer-to-peer lending is?
Sure. So it's relatively new in Australia, although it's been around in other countries for a bit longer. But essentially, rather than a bank taking your money and then lending it to somebody else by way of a loan, a peer-to-peer lender is a platform where people with money to invest can put it into the platform, and the platform then lends the money on. So there's no middle bank, as it were, and because the banks have to hold capital against deposits, whereas peer-to-peer lenders don't, there is effectively more in the margin, which means that sometimes you can get better rates both for the loans and for the deposits.
What kind of people are choosing to do this? Is it more likely to be younger people or, say, retirees?
Well, most of the peer-to-peer lenders are online, so those sectors of the population that are more comfortable with digital will be tending to go down this path, and that tends to be younger people, millennials or around there. But actually what's interesting is that now we're seeing more and more people getting more comfortable with online, and therefore the age range is actually extending upwards a little bit as well.
You say it's relatively new in Australia, but it's been around in other countries. How long has this been going for?
Well, some of the first peer-to-peer lenders were in the US more than 10 years ago, and they had a bit of a hiatus when, in fact, the regulators in the US intervened because there were major concerns about money just disappearing into the ether, as it were. Therefore, were relaunched about 5 or 6 years ago under different regulatory regimes. They've been very popular in the US. On some measures, you say could be almost a quarter of unsecured lending is now peer-to-peer. In the UK, it's also been around 5 or 6 years, and it's actually got government backing over there, particularly offering peer-to-peer loans to the small business sector. So around the world, we're seeing this relatively stable and growing quite fast now.
So over the years, it's found to have paid significant dividends. How much money do people stand to make on their deposits?
Well, it varies because, no two borrower and no two lenders are effectively the same. But typically, you might get double what you might get on a deposit account in Australia. And look, the rates on deposit accounts are horribly low here at the moment. So that's why peer-to-peer lenders can offer a higher rate of return. And in fact, it's possible to get relatively short-term savings, so let's say 4%, something like that, without too much difficulty. And borrowers also get relatively good rates on their loans as well. But of course, there are some risks attached to this type of business model because there's no capital standing behind it, which means that in a case of a borrower disappearing and not making that repayment, the risk then flows back through the system, and potentially your savings might be more at risk.
So that is the potential risk of this peer-to-peer lending, that your money might just disappear.
Well, yeah, so the more sophisticated models these days have some sort of insurance built in, so effectively it's not a one-to-one match between somebody who deposits money and the lender, and the borrower. There will be some sort of spreading of risks, but nevertheless there is no protection scheme, $250 million protected under the deposit scheme, nothing like that in the peer-to-peer lending sector. So you have to really consider the risks much more carefully, and be honest, higher returns equals higher risks. So if you're getting a bigger return on your deposit, just think about the risks that are attached to it. Well,
that was going to be my next question. Do the risks outweigh the benefits? What do you think?
Well, I think it depends on who you are and why you're doing it. If you're looking for a short-term higher return, and worst case you can afford to lose it, but perhaps get a bigger return, maybe it's worth it. And it's interesting that half of the loans being made are for things like home improvements. The other sort of nearly half is actually to do with debt consolidation. So there's a little risk there. If you're borrowing because of debt consolidation, be careful. But if it's your life savings and, if it disappeared, you'd be in terrible trouble, I would look at it very carefully.
Do you think that it will start to gain more prominence in Australia now? You said it's pretty mainstream in the United States.
Well, yeah, and the momentum is moving a little bit, but one of the biggest players here only has $150 million worth of loans at the moment, and there's $150 billion of